Hello and welcome to the Investment Markets Podcast, where we aim to discuss investment matters that impact self-directed investors. I'm your host, Darren Connolly, CEO at Investment Markets. And with me today is Clinton Arentz, Head of Lending from Trilogy Funds Management. Today, we're going to discuss income investing through private credit. However, before we get into it, I need to remind you that this is all general advice and general information only, and nothing in this podcast should be construed as an investment recommendation. As always, you will need to decide what is right for you. Welcome, Clinton.
Thank you, Darren.
Now, before we get started, Clinton, we need to maybe set the scene a little bit for the audience. So could you give us an introduction to the lending markets, what you are seeing in the market, what's happening on a day-to-day basis? There's been lots of noise in the newspaper, so a bit of a view from the coalface would be great.
Yeah, thanks, Darren. Look, from the coalface, I think the market's quite healthy. We actually see an enormous amount of demand for finished product. If anything, Australia's experiencing a housing supply crisis. There's no doubt about that, both in rental accommodation and owner-occupier accommodation, both in the regions and in the metropolitan areas. They're just simply not delivering enough housing. That's the critical test. I think the government's tried to tackle that with targets and the like and initiatives, but at the end of the day, they're still falling well short of delivery of homes required.
So we're just not building enough new stock?
Not at all. And so, you know, the simple factor of supply and demand kicks in then. So there's just not enough supply to meet the existing demand. And even though demand's tempered a little, demand is still sufficient to mop up all the existing housing that's available. And you can tell that from the occupancy rates, which are virtually 100% around the country.
And you mentioned that demand is tempered a little, but it's been front page on the news for quite a while, for the last couple of weeks for sure. Do you think that's just hype? It's just headlines. It's not actually reflecting what's actually happening? Sure,
and there's always that. I guess that's how the media operates. They're looking for the headline, but you know, below the surface, you'll see an industry operating in quite an orderly way. We find tremendous amount of demand for our capital, you know, which goes to provide funding for construction for new apartments and townhouses and land subdivisions and the like. So, going some small way towards, you know, meeting those, demand requirements. And of course, there's a healthy appetite for investors looking to tap into the same sector. There's not too many places you can get direct property exposure, sort of averaging around the 7s or 7.5, maybe even, a little higher in terms of a distribution rate, distributed monthly. It's a lot easier than managing your own block of apartments, for example, as an investor.
Probably that's a recommendation I wouldn't make unless you really knew what you were doing and had some experience in that space. Now, you talked to just a little bit sort of around the demand that you're seeing. Can you give us a bit more of a granular view into exactly where you're seeing those elevated levels of demand, whether it's by geography, by lending type, or by asset type?
Well, I think two types of demand, I guess. Investor demand, we see that as consistent across the board because of the type of asset class it is and the type of lending we do. Demand for our capital, our principal product is a construction mortgage product, if you like. We take that on a first mortgage basis only, so offering only the senior debt at relatively lower gearing, not dissimilar to what banks would offer at around 60 to maybe 65%. Maxing out at potentially 70% gearing. But from that point of view, there's a healthy appetite for investors, but there's a screaming demand from borrowers looking to build product. These smaller scale projects, and by that I mean, say, less than $50 million, and our average loan size is smaller again, those projects don't make it through the big bank process. The larger banks are a bit slow and cumbersome for the smaller loans in that sense, and yet that really goes towards the bulk of the solution for the housing crisis because that's where the bulk of the apartments get built. There's smaller scale developers all over the country, all up the east coast of Australia where we operate, all delivering some projects, be they apartments or townhouses or the like, to help meet that need.
And the banks have basically turned their back on that part of the market?
Well, of course, they're looking for economies of scale, aren't they? And looking for automation, and they need a simple model, I guess, and large scale. We run a more complex model. We have personal service for all our borrowers. Every borrower will be met with a senior portfolio manager. The whole credit process is done with great rigour, but it's a very personal process. We've got nearly 30 years' experience in doing this exact thing, lending on construction. And so the extent to which we can provide that personal and agile and quick service is the extent to which we can help these borrowers. And, of course, that helps them get their projects underway.
And do you see a pool of borrowers who are coming back to you multiple times?
Yes.
After one finishes, sort of they realise the relationship that they've built can provide benefits for the next project?
Very much so, and that's what we encourage. Every business wants to have repeat customers, so we very much encourage that, offering good service, as I said, a level of transparency and speed to market. Our response times are very quick, but that personal service, I think, is the key. And you're dealing with experienced people, and each of those experienced people have support staff, and some of those support staff have high levels of expertise in either construction or financial modelling or marketing or the like, valuations, quantity surveying and that. So we like to think that we can add some value along the way. We certainly manage the project very carefully, and in doing so, it helps the developer, the builder, have some rigour in terms of how they complete the project too. And, of course, it ensures a timely supply of capital, which is the lifeblood for all projects.
So I was just going to ask, what are the top 2 or 3 things that a borrower really makes the difference for them when they're getting a project out of the ground? And you may have just alluded to so probably the most important one there, but is it all about speed?
Well, Darren, good question. And that's from the borrower's perspective, probably yes. But from our perspective as a prudent lender, we take as much time as it needs to take to do the proper assessment. So it's balance, providing the borrower helps us with the correct information, and often that's through an intermediary. There's a very large-scale mortgage broking industry in Australia. We tap into that through decades-long associations with various broker groups. So we've got a very healthy supply of new opportunities. Our supply pipeline for new opportunities is phenomenal, really, and that's the strength of the brand, I think, in the 30 years of trading history, et cetera, that carries the day there. But the borrowers would want speed and agility and flexibility and good cooperation and a timeliness in response and the like. But they also want professionalism and they want certainty. So the other element is that we can provide the certainty because of the rigour by assessing the loans carefully up front and going through quite a detailed process. Then the borrowers know we're solidly on board if they get an approval, and because of our pooled mortgage structure, which gives us deep capital pools to draw from, they can be certain of their monthly construction draws as well.
And if we were to flip it around and look at it from an investor's point of view, why do you think those things matter so much to investors? They're looking for particular things. It obviously, the asset plays a role within their portfolio, a particular role within their portfolio. What boxes do you need to tick for them?
Well, just going through, I guess, the security aspect, if you like. So we're on a first mortgage basis. That's senior lend for a start. So we're first in the capital stack. And as a result, we prepare the facility agreements, and they're detailed loan documents which set out how the project will be conducted and all of the various metrics that the borrower has to fulfill in that sense. So there's an enormous amount of rigour in the terms of managing the loan. But there's also good governance for how we manage the entire loan book in the company as well. So good governance, transparency, ethical dealings with everybody involved, as well as the timeliness, I think, is the key. And as a small to mid-sized company, we can offer both, the depth of capital and the resources, but also the agility as well. That's what we'd like to see as our sweet spot.
Yeah, the agility that they probably wouldn't see with a sort of bank lender trying to operate in that
Look,
space.
they have a place in large-scale lending, agribusiness lending, export lending, hotels, resorts, I guess, large-scale office towers. Most of our projects are short-term. coming back to your investor question, we offer quite a diverse loan book in that sense, across a range of asset types, but predominantly all types of residential, but geographically very well spread as well. So even a small investment starting from $10,000 in our monthly income trust, for example, gets you into that direct property market in a way that you simply can't do typically as a small investor.
And if we looked at sort of some of the noise, and I'm maybe stepping back up to the market now, there's been news headlines around drops in property values in Melbourne and Sydney. Have you seen any of that just anecdotally in the marketplace?
Yeah, it's interesting, Darren. I mean, we've seen hesitancy, definitely. I think since the budget was first introduced, by the Treasurer, Jim Chalmers, there's been a hesitancy in the market. You'd have to expect that. I think that's probably healthy too. I mean, apart from the fact there's large-scale restructuring underway, investors have a chance to think and plan their options. And of course, those people sitting on the fence that were out of the buyer's market have a chance to reconsider their position and maybe stepping forward, and perhaps they can step up, depending on how the ultimate budget is gazetted, I guess.
So you have a view then maybe that the changes in the budget, particularly to CGT, are going to drive some changes in long-term investor behaviour? Would that be a reasonable expectation?
I think so, Darren. And I think if you look at what the Treasurer was seeking to do, that was certainly the intent, was to change investor behaviour, if you like. And the way we see it is investors are protected with new stock off the planned stock. So that actually helps the development community because that's what they do. They build new. So in that regard, investors are still well advantaged. It might potentially soften the resale market a little bit, or the secondary market, but then that'll immediately open the opportunity for new owner-occupiers to enter. As I say, those folks who've been sitting on the fence outside the affordability range just can't quite get there because investors were driving up that secondary stock. Well, now the younger owner-occupiers have got a chance to get into that market too, perhaps. So ideally, the Goldilocks version would be the best case outcome. It drives new activity. It helps stimulate development activity, if you like. But the secondary market will be supported because, as I said earlier, the occupancies are still tracking at roughly 98 to 100%.
It always ultimately comes down to supply and demand.
It sure does.
Clinton, doesn't it?
It sure does. And this is a homeless crisis on top of everything else. So certainly people are doing it tough, I think, with accommodation. And if that market just softens up a bit, that'll get us back to more of a long-term average anyhow, I think. I think it's healthy.
Yep.
Yeah.
Do you think we were just spoilt in having house prices on a rampant tear for about 15 or 20 years? We just got complacent or used to it going that way?
We're a very lucky country, aren't we? So we've had a lovely run in Australia, and you can take any sort of view, I guess, but my view is that I think successive governments over time have created a fabulous country. There's nowhere else you'd want to live. So, and investors, I think, feel that way, and certainly our developer clients. I can assure you, despite all the budgetary commentary and that, developers are actually mobilising because I think they see light at the end of the tunnel. You've got a significant state election in Victoria coming up soon. You've got relative stability in Queensland and New South Wales, Western Australia powering along with the commodities strength. The states are in pretty peachy health, and large-scale infrastructure spend underwrites jobs growth. And so a lot of our lending goes into the regions where the jobs growth is. So we go where the jobs are, basically, because that's where people want to live.
And there's a lot more infrastructure spending coming, isn't there? Particularly in southeast Queensland with an Olympics on its way, which we haven't geared up for yet.
No, and that sort of creates a level of buoyancy for the economy locally here in Brisbane and southeast Queensland, but it'll become more and more buoyant probably over the years to come. So typically it's a bit of a straight line trend through to the Olympics, but you never know. I mean, there's a whole global geopolitical cycle ahead, and there's business cycles ahead. So we kind of plan for all contingencies, Darren, even though the market's been as rewarding as it has for long-term investment. We always factor in what happens if markets slow, what happens if there's a downturn in prices, for example. So each of our loans, even in the most buoyant of times, we'll factor in these scenario analysis in terms of delays and cost overruns. And even then, we always allow for a margin to deal with that in the normal course.
Now, Trilogy's been around for 20, 25, even a little bit longer, actually, I think. So through the time, we've seen sort of GFC, we've seen quite a few markets ups and downs.
Definitely.
What do you think it is about Trilogy's philosophy or ethos that actually means that it's been able to stand the test of time through all that upheaval?
Pragmatism, good risk management, risk awareness, obviously, a heightened level of risk. The business has been through those multiple cycles, but it started small and it's grown organically. It's had no forced growth, all of the growth over those 27 odd years.
27.
Depending on where you draw the line.
I knew it was around that point.
Well, it depends who you ask, Darren. But I think the official long-dated version is around 27. But look, a heck of a long while, enough to see huge change in the markets across all of the East Coast as our predominant focus. But yeah, I see, as I'm lucky enough to travel, the infrastructure rollouts in all of the states and the regional areas of those states as well. And I'm sure there's a strong jobs growth period ahead. So I think that'll be, once again, good for property investment.
Yeah. There's always the positive, but then maybe sort of the flip side, because too much of a good thing can actually be bad for you. But do you think a lot of that construction is going to fuel maybe some inflation in the space, demand for experienced tradies, and then challenges with getting those tradies onto site? Have you seen any pressures on the developers from that point of view?
Yes, for sure. That's a real trend, and it has been for a while. I mean, during the COVID period, which stretched out to 4 years in some cases, some states more adversely affected. I mean, that itself was inflationary in a lot of ways because there was a constraint on supply. And so more recently, of course, with the Middle East situation in Iran and the like, that's also created a constraint on supply. There's a constraint on the supply of tradesmen as well as materials. So that's another constraint factor which drives pricing. So, and there's just not simply enough supply to meet demand ultimately. So I think that tendency for prices to continue to increase is to some extent, in my personal opinion, inevitable, because that's been pretty much my observation over the last 30 years.
Yep.
It just is the case. There's more human beings on the planet. There's more in Australia, and there'll be more demand, I think.
Yeah, and when some of that demand gets sucked up into other projects, it creates a scarcity.
Yeah, right. Well, that's I guess your more focused question, and that's a good thing to focus on too from our discussion, because look, that does have its own tempo. The construction around the Olympics projects will all be tier one builders. They'll be larger scale projects. They're well beyond the scope of anything our developer clients would typically look at in scale or complexity or the like. But
so is it a two-tier
totally,
sort of market?
It's often a two-tiered market. You'll find the larger scale projects, which become unionised at a certain point, inevitably have all the carry costs that come with that, larger scale, particularly government planned project. And the builders have got the luxury of choice now. They can cherry pick their own projects, and it will be tough for the state government to manage the time deadlines, let alone the budgetary deadlines or commitments. But that's the state government's problem, and hopefully they'll be enriched by the successful Olympics. But for the small-scale developer, his builder relationships and his sub-trade relationships are usually years in the making as well. They rely on personal relationships, so they get the job done.
Yep. Now, ASIC has been very focused on private credit, and I use that in a very generic label sense, highlighting what it believes are some lax processes that sort of sit within that part of the market. I'm sure you'll have sort of been across the reports and have a view maybe on sort of ASIC's reports, and then probably how Trilogy sees itself relative to that.
Thanks, Darren. Look, firstly, we welcome ASIC's interest in the sector and any regulatory authority for that matter, because that suits us. We've always had a heavy compliance regulatory framework model in mind. I mean, we've always worked towards the day that the regulators would take a greater interest, and that's partly because private credit's grown by about 10% per annum for the last decade, not just in Australia, but internationally as
Even
well.
higher overseas.
Yeah, absolutely.
Yep.
And it's nearly 80-90% of the total, property development or construction market in the States, for example. And it's rapidly rising in the UK and Europe, as you know. And
in a way, I think Australia is only playing a little bit
catch
up to those markets.
I agree, Darren.
Yeah.
I agree entirely. And it's been very quietly spoken for quite some time, the private credit thing. And it's only that ASIC have taken some interest that starts to, generate headlines. But we've found, some of our competitors, maybe there's some opaque practices there as well. We don't know. But we know our practices are very cautious. And we very much welcome the opportunity to sort of participate in that. And we have already. And of course, we read the reports thoroughly. With great interest initially, and now I guess we're looking to follow those. So ASIC very kindly gave us a good governance, good conduct set of standards at the back. It's like best practice for sector. So we're assiduously working our way through those, Darren.
Yep. And do you think they'll have an impact in other areas of the market? Like what might be the implications of those reports?
Look, I hope it does, in the sense that I hope it'll create clarity for investors and more certainty, more confidence in the sector. The sector's got plenty of fans as well, all the big investment houses of the world, effectively.
The institutional money is continuing to flow into the sector, isn't it?
Absolutely, because the opportunities are there, and it goes to fulfill the needs and demands we talked about earlier. And of course, the investor appetite is there as well too. So it's really marrying the two. Investor appetite, looking for reasonably simple investment options. In this case, linked to first mortgage, direct property, and there's lots of that weight of capital looking to seek that investment home, if you like. Equally, there's just as much demand from borrowers to take that out as fast as we can raise it, because they've got these smaller projects that they can get started with. The big delay factor still is more in the authorities' approvals and the back end, getting final sort of sign-offs and certificates, and the titling process is still much slower than we'd like it to be, Darren.
Yep.
That puts a lid on supply, unfortunately.
Yeah, it's not like Australia to be a little bit bureaucratic in some of these things.
Unfortunately not.
Now, Trilogy also invests directly into real assets. And I noticed in particular in the industrial and retail space. So how did that come about in terms of the lending side moving into the real asset side? And in particular, I'm quite curious to know why industrial and why retail. I'm sure there's an investment thesis that sits behind both of those choices. But if you could tease those out for us, that would be great.
I'd love to, Darren. Yeah, thank you. And look, I was involved with the Industrial Trust from the start, Trilogy Industrial Property Trust, and that was an opportunistic exercise for us in the sense that industrial property was undervalued to our mind. There were high quality tenants, looking to continue to grow their businesses. And a little bit like residential property, there simply wasn't enough existing supply. So over the time, we've acquired 16 odd, separate projects, all of which have maintained substantial occupancy, if not 100% occupancy, and they've grown significantly in capital value in the main. So that was a cyclical play in the sense of we saw the opportunity there for value. In some cases, we were actually buying these big warehouses and storage sheds at below replacement cost, which was a pretty good barometer. When
doesn't happen every
good
every
value.
month.
Once every now and then in the cycle, you might get that opportunity. So we built that out. We were keen to still maintain diversification geographically and with tenant type. So we've diversified in both ways there and built that up nicely over time. We're still making acquisitions even now. We've got acquisitions in pipeline at the moment. So that's effectively a national trust with assets in most states, and that's up to 320 million assets under management now in the Industrial Trust.
And you're still positive on sort of the industrial sector and what it can do for the fund?
Well, as I said, it was counter-cyclical when we went in because the market was a bit unloved for industrial property, larger scale particularly. So The institutions played a part at the very big end, but there was a gap well under that we could participate in. But we've found nothing but growth in the sector, and I think that once again there's just not enough product to supply. So we will continue to take opportunities to purchase where we can. I think investors will hopefully be rewarded with good occupancy levels through the entire asset registry in that sense. And funny enough, it got a second win post-COVID because everything was about last mile supply logistics then. So
in the same way, office came off because of COVID.
Yes.
Industrial went the other way.
Yes, exactly. So we sort of continued to ride that positive cycle in that sense. And retail was a bit the same. It was a counter-cyclical opportunity too. And once again, virtually COVID-proof because these centres, large-scale neighbourhood retail format centres, all traded through the COVID period even. So,
and are they the particular type of assets that are sitting in that retail trust?
In the main, yes. And there's some variations on that theme, but that's our target, if you like, anchored by a major supermarket-based tenant and some specialties to generate the additional income as well. But those centres were selling more cheaply than they perhaps are now because the market's cottoned onto that asset class.
Everybody
as it has
still
with
needs to
industrial.
eat.
Exactly. Correct. Yeah.
So the thematic, again, a supply and demand thematic underlying basically all of the activity. Is that a fair?
Yes, and effectively we see ourselves as a large scale property house, Darren. So whilst lending has been the foundation product for a very long while through our mortgage income trust, property assets and property investment has always been a central theme as well.
So maybe if I can ask sort of a two-parted question on that. So we've got the lending side and we've got the direct asset side. So if you look forward over the next couple of years and with both in mind, what's your outlook for the lending side and what's your outlook for the real assets side? Where do you think investors should be looking and why?
Well, I guess both work for different reasons, I would argue, Darren. I mean, the lending side, I think, is very strong. I mean, this is my personal view, but I sense that, through, all our various marketplace sources and the contact points we have in the direct market, if you like. We are at the coalface in that sense. And there's tremendous appetite from builders and small to medium-sized developers to get on with building product. And as I said, equally, there's as much demand to meet that supply as it can come on. Still think there'll be a housing shortage and a supply shortage, so that just puts a little bit of a floor under the market, if you like, and hopefully encourages positive growth. So I think direct lending in that sense, and from an investor's point of view, direct access to property investment through that mechanism seems to make perfect sense going forward.
Typically for investors who are looking for that income flow to flow through their portfolios into
well, these are quite liquid funds. I mean, investors are able to redeem after a short period of time, so there's a permanent redemption window open after a suitable period of months to notify. So it's relatively liquid capital. Investors can start small. We have very warm and friendly investor relations team that meet people and talk to people firsthand. So
that's very old school, Clinton.
Yeah, no offshore call centres for us, Darren. So
or AI.
So the folks who deal with our retail investor customers are absolutely on the same floor as I work and the Sydney crew work. So they can reach out and touch us and ask questions if they need to, and of course they do. So make ourselves very accessible to our investor clients.
And maybe sort of it's the same question, I guess, for the direct assets side. Yeah. Both the market and also the sort of the two areas of speciality being the industrial and the retail.
Well, I guess you might be surprised to hear I'm bullish on both, but I guess particularly because I know this industrial sector quite well. I've been involved with a lot of the acquisitions until it got big enough that we had to have our own senior property team. But look, it's driven by regional growth. I mentioned earlier you've got state government infrastructure, you've got federal government spending as well on defence, you've got spending on health and education. These are large-scale economic drivers. These are large-scale job creators. That's where the housing is needed, and that's where it works the best. So we're prepared to support those markets as and where we can in the geographies that suit us.
And maybe just one final question, Clinton. You highlighted you're bullish on the sectors, which I appreciate. If I'm a self-directed investor looking at this part of the market, what would be the one thing? What's the canary in the gold mine? What's the one thing I should just keep an eye on and watch out for?
Well, there's always something, Darren, isn't there? I guess.
Well, it could be Mr. Trump could be on his his phone again in the middle of the night. Who knows?
It could be. In fact, highly likely there'll be some new event. I think the only thing you can safely assume is that there'll be more surprises to come. So I think the secret to most investors' success there is the age-old concept of diversification. Going in gently to start with, learn your product types, learn to understand the market. Certainly from Trilogy's perspective, we try to provide as much information as we can, but each investor must make their own assessments. But
of course,
research, look, learn, get involved. I mean, direct property is relatively easy because you can touch and feel that. Even if you look around your suburbs and the cities where you live, you'll soon see whether property's selling well and leasing well, or whether there's to let signs or for sale signs everywhere.
Yep, or the auction market has maybe just disappeared.
Well, the auction market has disappeared, and Darren, I'm fascinated by that, but I noticed the number of listings has backed off as well. So I think it's a bit of a buyer's strike while they wait and see. And I think vendors are sitting on the fence a bit too. You're not seeing a wholesale lift in listings, which is interesting. So once again, price stability is there, but at reduced levels of volume, I think, Darren.
But ultimately, I think Clinton's always going to come back to supply and demand. And
has to.
For as long as there's some constraints on that dynamic, I think it augurs well for the market.
And that's so true, Darren. And I think that some economic drivers there which can't be denied. I mean, the defence spending alone is staring us in the face now as a nation. We've got massive defence spending underway. I'm conscious, at least in Northern Territory, Western Australia, South Australia, there's large-scale investment. Then again in AI and infrastructure around fibre optic cables and solar panels and wind generation and the like is massive investment undertaken across the country. As there is with the hospital rollout and other major freeways and railways and the like. So pretty exciting time, I think, to be in business in Australia.
Well, I love the optimistic view on the investment sort of life cycle and the way things are unfolding within Australia. I think, as we said earlier, Clinton, there's no better place to be.
That's right.
Thank you very much for your time and insights today, Clinton. It was great.
My pleasure.
Thank you also to everyone for listening or watching. I encourage you to follow or share on your channel of choice, as it makes a huge difference in helping people find us. And for more insights from experts like Clinton, and to search, find and compare hundreds of investment products all into one place for free, including Trilogy's funds, go to investmentmarkets.com.au.